Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, February 6, 2018. We're looking at a daily chart of the SPY, which is the proxy for the S&P 500. And it was another crazy day out there in the markets. Overnight, the futures markets were selling very, very hard, and the markets in Asia were selling, and that's normal, and we talked about it last night, the fact that that was likely to happen, so there was no telling how much the market, if it was going to be down today, could be down. But we obviously, as you can see on the chart, had a reversal on our hands, and you can see where we went to today. This morning when the markets did start down, we went to that 260 and a quarter area, this line on the chart that we identified last night. We went slightly below that, but we snapped back with pretty good authority. And this coincides with the discussion we had last night about a rubber band being stretched, and it's either going to break or snap back. Well, yesterday it appeared to be broken, but today it was repaired, at least for the time being, and we did get a snapback. And this goes really on the flip side of the conversation that we've been having for a long, long time about overbought markets and oversold markets, and we kept having it on the upside. As the market was rising, we kept getting farther and farther away from the 20-period moving average, which is known in my world as home base. And I kept saying over and over again, the market's getting too far from home base. It has to come back toward home base. Well, if you flip that upside down, you can see how far away we were yesterday and this morning from the 20-period moving average. The 20-period moving average on this chart is the red sloping trend line, and you can see we got very, very severely beneath the 20-period moving average, and anytime we get too far away from home base, the market is likely going to snap back. It's just a matter of from what price. And also, as you know, and I say this over and over again, markets can go higher than most people think they can, and they can also obviously go lower than most people think they can. We've had a couple of wild over 100-point swings in the S&P 500 over the last couple of days. In fact, yesterday it was way more than that. So it's uncharted territory for the market. But as you can see today, we did have that snapback, and it was a very interesting reversal. And you can see on the chart, there's a 269.37. It's a brown trend line running across horizontally across the screen. What does that line represent? Well, that line represents exactly a 38.2% retracement, taking this pivot high to this pivot low from this morning. And today, in the afternoon session, we reached a 38.2% retracement of those pivot highs and lows. That's telling you a couple of things. That the market's not broken, it's actually trading very technically sound. When we have a market that appears to be wild and crazy, volatility spiked up, and the market appeared to be somewhat broken, and then all of a sudden, after we made a low today, we make almost spot on to the penny. Almost to the penny. It was only about 40 cents away on the high today, but we make pretty much a spot on 38.2% retracement. That's when you know markets are technically sound and they're doing exactly what they're supposed to do. Now, where do we go from here? Well, under normal market conditions, this isn't over just yet. What I mean by that is it's unlikely that the market just ramps up, we go and make new highs, and everybody forgets what happened. That's generally not the way it works. There was some damage done to the market, and generally speaking, it would not be out of the ordinary to see some kind of a retest, or at least an attempt at a retest of the lows. The market's not going to just rocket higher from here. That's just not the way it works. Is it possible? Yes, it's possible. Is it probable? No, it's not probable. There's going to be some back and forth, up and down behavior. Volatility is still elevated, and as volatility is elevated, you still have shorts in the market, you still have buy the dip crowd that thinks everything is fine, and you still have bulls and bears, and they're still going to fight each other every step of the way. Here's an hourly chart, and just for example, right above us, we have the 20-period moving average on the hourly chart coming into price. That will provide, at least from an intraday perspective, some level of resistance. Above that is the 200-period moving average. The 50 period is the blue line, and the 100 period is the purple line. All these particular moving averages will provide resistance to the market, and just because, I'm going to go back to the daily chart, just because we made a 38.2% retracement, that doesn't mean we're going back to the old highs. It doesn't mean we're going to make new highs. We could go straight down from here with another leg lower. In fact, don't be surprised if we get a retracement of the retracement, meaning a retracement back down, at least in part of the retracement we got up today. This is the way markets work. They never make it that easy. They're not going to just blow off the last few days of heavy selling we had and make believe it didn't happen. That's not the way markets work. So as a result of what happened over the last couple of days, we had a number of things happen. We had some of the inverse exchange traded products, meaning the inverse volatility products, actually announced that they're going to collapse. So one of them, I believe, was XIV, and you can see what happened. XIV on Monday closed at $99 or whatever the closing was. Yeah, $99 even, and today it was halted. It did open up at some point during the trading day, and you can see we're at $7.35. Apparently, and it was reported this way, I don't know this for a fact, but apparently there were some hedge funds that were holding this and other vehicles just like it. Obviously, retail investors were holding this, and it's unfortunate they're going to lose their money if they haven't got out yet. Whatever they can get out at is all they're going to be able to recover of whatever they had invested in this product. This is a leveraged inverse volatility. So just to give you an example of what this really is, here is the actual VIX chart, the daily VIX chart. So as the VIX goes up, the inverse fund would go in the opposite direction and vice versa. So that's one of the things that did collapse yesterday. And the other thing is, and I don't know exactly how many, but from what I understand, there were some hedge funds that collapsed because they were too far out on the margin ledge. Many hedge funds trade on margin. They have what's called leverage. Some of them may be 4-to-1, 8-to-1, 10-to-1. There once was a time in 2006, 2007, 2008 when hedge funds were leveraged 20, 25, even 30-to-1. I don't know that we have that anymore, but certainly we do have leverage out here, and some of the hedge funds that were in the wrong vehicles obviously collapsed. And the reason I bring that up is because if there is, let's just say there were 3 or 4 hedge funds that collapsed. I don't know the number. Let's just speculate and say that there were. That means to me that there's probably another 3, 4, maybe even 10 behind it that are teetering on the verge of collapse. So I'm suggesting that the selling pressure, the volatility is not necessarily over. I don't think we brush it off and just make new highs. That's not what my expectations, and I don't believe that should be what your expectations are going forward just yet. Could we retrace more? Could we retrace half of the decline? Absolutely. Could we get up to 275 in that neighborhood, even 278? Absolutely we can. We'll see what the next couple of days brings. We're going to have to take it one day at a time. And when the volatility is elevated to this extent and you're taking a position, let's say you want to buy a stock or want to buy an exchange traded fund, whatever you're buying, because of the wild swings that we're having, at least for now, until that subsides and the market calms down, you trim down your share size. You take less of a position because the volatility is elevated. Therefore, the swings that whatever vehicle you're purchasing are going to be accentuated to the same degree. So if you're normally buying 500 shares of something, you buy half that amount, or 2/3 that amount, or 1/3 that amount. Everybody has to assess what their own risk tolerance is. IWM. Here's one thing that we didn't discuss last night, and I want to bring it to your attention. We have all month to talk about it, but I think it's very, very important. The upsloping trend line that we're going to be very interested in, this upsloping purple trend line that's drawn over from the monthly chart. It's going to be very interesting to see if we close back beneath that trend line at the close of the month of February. So January we did close above it. We've closed above it for quite several months, quite a while. As you can see, this is the monthly chart. We've been riding this trend line, and then we began trading above this trend line. Now we're back below this trend line. I think it's extremely important, and I think if we close back below this trend line After February is over, on the last day of the last trading day of February, it's going to be very, very important. It could be a failed breakout. Where did we go today in the IWM? 144.50 was the level we identified. We pierced it by just a few pennies and had a rocket ride off that level. That was a very, very important level. So even though it doesn't look like it, as you go from one market to the next, these markets are trading technically sound. Even though the volatility is elevated and things seem crazy out there, technically speaking, there's nothing wrong with these markets. They're trading just as they should be, both on the down and the upside. Taking a peek over at the transports. The transports were actually our canary in the coal mine. They were actually breaking down before the IWM broke down. IWM is my favorite market leading indicator. Transports is in second place. But this time around, the transports were our canary in the coal mine, and we flagged it early. Where did the transports do? They went right to the 100 period moving average, slightly below it. The low today happened to be 10,121, so we almost got back down to 10,000, and we had the rocket ride off that level. Everything got a lift today. When you see markets reverse like this, then everything gets a lift. A rising tide lifts all markets. Okay, before we move on to other markets, there is something I want to show you which I found very interesting. This is the E-mini 500 contract, the daily chart, and you can see what happened. Last night, around 11:30, quarter to 12, right before midnight, so that was Monday, right before midnight, the market, or the S&P 500, was selling off. The E-mini contract, the futures market, were selling off. That was after Asia opened, and they were responding to our market selling off. And the market went right to the 200 period moving average. The 200 period moving average, 25.33.60. And I'll show you the low. And the low last night happened to be 25.29 on the button, just 4 points below the 200 period moving average, and we had a rocket ride off that level. So the market needed, in its own terms, to satisfy that. Once it did, we never revisited that level again. Not during the trading session, not during the pit session, not in the overnight session. Once we satisfied the 200 period moving average, that was all she wrote on the downside for now. And again, a day or two in advance, you don't know that that's going to happen. But once you see that happen and you see the market respond to a 200 period moving average that the market hasn't visited in quite some time, and we stop short and reverse trend right at that level, that's when you know that the market is still trading technically sound. Looking over at the gold market, switching gears, gold market was down today. The candle we're looking at is the last red candle. It's a down candle. So this market opened this morning around 1343, I believe. So the opening print was 1343.10, and we closed at 1329. So it was a down day, and we're below the important 1338, and we're also below the important, what I believe to be important, at 1333. So we could see some more downward pressure in gold. What I found interesting was, even when the stock market was melting down, you didn't see that quote-unquote safety trade into the gold market. Under normal conditions, it would be normal to see the safety trade running in or money running into the gold market. We didn't see that, so that was my first indication that the gold market was struggling a little bit. We didn't see buying activity in gold. I'm not yet suggesting the gold market is breaking down. It could still be a bullish pullback pattern in an uptrend. We'll have to wait and see how gold reacts to the level down here in this consolidation area, if and when it gets there, and whether or not it holds these moving averages. If not, then gold may be going down and may have significantly farther to go on the downside, but it's too early to tell. We need more evidence. We need gold to at least hold this last consolidation area. If it doesn't hold this last consolidation area, then there's most likely trouble brewing in the gold market. Crude oil. While we did get below the 20 period moving average in crude oil, there's still technically nothing wrong with this market. We're technically still in an uptrend. The 20 period moving average certainly is important, but it's not of grave importance we can simply get back above the 20-period moving average and continue the uptrend. I still don't believe the uptrend is over. I still think we have $73 to $74 in the cards for crude oil. It's not going to happen overnight. We need time to consolidate, and I think that's all crude oil is doing right now, is consolidating for another move higher. It just most likely needs to eat some more time off the clock before making a secondary move higher. And with that, folks, it's everything that I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.